Well, all right, Gary, Cameron, hey, see you guys. Nate, B, hey, I met you at the Real Estate Investors Association presentation Lynn and I did last week. Good to see you. We're going to get started, even though all of our registrations are not online right now with us. So thank you guys for being on time. I want to be respectful of your time. So I'm just going to go ahead and turn it over to Josh. This is his presentation tonight. We've had Josh before. You guys are in for a treat if you haven't, participated in some of his trainings before. Very thorough, very articulate. We always learn a ton. Take notes. We will record this. We are recording this. Josh, I'm not sure. You probably have slides. If you do, we'll share slide decks. And reach out to me, guys, if you have not seen. Well, Josh, are you kind of combining your state of the market kind of address that you did before in some of this?
I am. Yeah, that's
Okay.
exactly kind of where I'm going with this. But if you're okay, I'll kind of just start to frame this up for everybody.
Yep, let's go.
Okay, cool. So team, what this basically is we're all abundantly aware that this is, if not the hardest, one of the hardest markets for buyers to compete in. And I have been collaborating with some of the top mortgage lenders in the country that are in one of my coaching groups. And really, we've come together saying, how do we create a bulletproof buyer strategy where we arm our buyers with kind of all of the things that we're doing individually or maybe even compartmentalized, but how do we educate those buyers on the front end and arm them with every possible solution to navigate this challenging market and ultimately be successful. And so some of what you're going to see me run through tonight, and I'm going to do it at a faster pace than normal because some of this is a repeat. But what I've done is essentially put together a presentation that we would bring to a buyer to help educate them what's going on in the market and help to arm them with everything they need. So with that, Jeff, I'm going to try to share my screen. Hold on. And there. Okay. You see my screen all right?
Yep.
Perfect. Okay. All right. Let me get this expanded and get the video in the right place. Perfect. Okay, great. We should be rolling now. All right. So let me just kind of frame this up. So see if you can relate. Buyers are tired. Agents are tired. Everybody's exhausted of this market. There's endless searching and multiple offers are leading to heartbreak and disappointment for lots of buyers. The frustrated clients are looking to us for answers and results. Not being able to provide them has left them feeling helpless and powerless. That's some of the stuff that I'm hearing back for our clients. Like I've got 3 loan officer assistants, loan processors, people in our individual offices that are looking for houses right now. And that's the feedback they're giving me. Just, I'm feeling helpless. I'm feeling powerless here. So until now, we've just been following the same routine, kind of hoping that yesterday's results would be effective in today's market that has changed dramatically. And part of what I'm going to share with you is that I think this market, this insanity might exist longer than any of us are thinking. So again, just to frame this up, what we want to address with this presentation that I'm giving you tonight, but ultimately this would be a version of this is what we would give to a client and help to arm them with as they go into the market to buy a home to help make them bulletproof. So the issue that we're trying to address is buyers are scared of the market. It feels like the market's moving too fast. I've heard my teammates inside the mortgage space, our loan processors, loan officer assistants that are buying a home, they're saying that they feel uncomfortable, that they're being pushed by their realtors to hurry and write an offer and, waive earnest money and kind of being like thrust forward at the speed that they have to compete, but they don't feel educated to understand why all this is going on. So we believe they need data. They need to be empowered to make their own decisions and take the emotions, opinions, and conjecture out of it. So make sure they're rooted in data, number one. And then we need to help them plan for what happens when an appraisal comes in low. which is what Ben presented on a few weeks ago, but we've incorporated as part of this Bulletproof buyer strategy. And then they need to be able to compete with an all cash offer. So we're kind of combining all of the strategies that we've talked about up until now into this Bulletproof buyer solution. So to break that down and just a quick review, and then I'll kind of really jump into the presentation. It's a comprehensive upfront market analysis. Clients need to understand why the market is insane like this, not just know what's happening, but why it's happening. We want to talk to them about an appraisal gap strategy, knowing how to approach low appraisals from the onset, talking about, waiving appraisal contingencies and what that's going to do, what that could mean for them, and how they could potentially come up with capital and different resources to bridge the appraisal gap. Fully underwritten approvals. So these are like not pre-approved, not what's the other word I was looking for? Pre-approved, pre-qualified. Geez, that and my math skills. I know it's the end of the day. So not pre-approved, not pre-qualified.
Move this up an hour, Josh. You're not any better now.
I know. Can you imagine what a wreck I would have been in an hour? Fully underwritten pre-approvals is what we're suggesting here. And then the ability to submit all cash offers. And Jeff, this goes back to that training that we had with Revive. So I'm essentially combining all of this information, all of these strategies to educate a buyer on what they're likely to face in this market. And also tell them that, your reward, your upside for going through all of this extra work in this market is that because of the supply imbalances, you're likely to have really strong appreciation still for many years to come. And you're going to lock in an interest rate that's less than half the historical interest rate over the last 30 years. So yes, there's challenges, but there's also big opportunity and big rewards for culminating these strategies and going through the extra work it takes to buy a home right now. So since some of you have seen this, I'm going to go through this, much quicker than I did the first time, but I want to I'm beta testing on you this presentation that we would basically be giving to clients to educate them and arm them with everything they need to be a bulletproof buyer. So this, for anybody who hasn't seen this chart, this is new housing starts. And after 2008, with the Great Recession, the number of housing starts plummeted to about 500,000 housing starts. And according to the National Association of Realtors, who just came out with data, this hole that hasn't been filled is 4 million homes. So America is short 4 million homes in order to be kind of a normal market. And I would suggest or offer that that's going to take a while. I mean, if you look back historically to 1977, home builders have built about 1.5 million homes per year, except for this giant gap between 2009 and 2021. And oops, there COVID hit. So the construction numbers went way down again last year. But this gap of 4 million homes, according to the National Association of Realtors, that's going to take a while to fill, which means there's going to be a lack of supply and likely to see more appreciation. Again, I'm going to go through these.
Josh,
Yeah.
let me interrupt you real quick.
Please.
You just mentioned that you go more in depth on this in a previous training. Some of you may have missed that previous training, so I just put my email in the chat. We did capture that training. It's more on this supply and demand that he's talking about. I don't want you to miss any of this. This was fantastic information. We've got slides for you. So send me an email if you want a copy of that previous training that goes a little bit more in depth than what he's covering now. Sorry, Josh, go ahead.
Yeah, no, thank you. That was a great point. And if I'm going too fast, just raise your hand and I'm happy to pause and answer questions. Okay, so again, just explaining to a consumer that, the number of single family housing units completed after 2009 for 13 straight years was below the 50-year average. So if we get into the why there's a shortage of housing, it's because builders got demolished by the Great Recession, and they have not been able to get back up to the construction levels that were normal in the previous 50 years. Again, if we look at housing industry nationwide, we've seen the housing industry, as it relates to a percentage of total households in America, has never been this low. Never has there been 1 month supply nationally in our country since they started tracking that kind of data. And just since, if we want to put this in context, because I hear clients say, or I have heard clients say, boy, this feels a lot like 2007 before the housing crash. And I say, well, the only thing that's really the same between now and 2007 is that real estate was really popular and housing prices are going up. But what was happening in 2007 was we had 3.7 million homes for sale. Today, we have 1 million homes for sale. So that's like a 70% haircut. There is a lot less homes for sale in this country. Why? Because let's see, which way am I going here? Sorry. Why is that? Well, it's because builders have not been able to keep up for the last 13 years. So it's very different. Today is very different. In fact, it's the exact opposite of 2007 before the crash. So year over year, oh, check that out. Did you see the headline said down 71%? I actually just did that math in my head. So just keep that in mind, Ben and Kyle.
He's back, ladies and gentlemen. Get some mushroom tea just a minute ago and we didn't see.
Actually, I did have a little think tea. Thank you. Good call. All right. So if we take this from a kind of a national footprint to locally, we can see that housing inventory in the state of Utah has just, plummeted over the last year. This is according to Realtor.com. Our inventory has gone down 68%, where the United States is only down 52%. So we're feeling this full force. And again, back to that comparison of 2004 to 2007, this feels a lot like the recession. Well, yes, because housing prices are going up and real estate is in vogue again. But the difference is in 2004 to 2007, builders were way overbuilding and you had massive number of supply. So in 2007, you had 9.6 months worth of inventory or housing supply nationwide. And 2020 was 2.1 months. We know that this year we're down to 1 month's inventory. So it's a very different market in terms of the supply dynamics of housing because of the builders that really got obliterated. The other thing,
Josh,
yeah, please.
can I add one thing to that?
I'd love you to.
I had a guy that I've done a few deals with. He's an investor and he's thinking, he said today when we were talking about his plans for the future that he was hoping to take advantage of some foreclosure activity because he feels like we're on the edge of that. And so I spent some time discussing why I didn't think that would happen. And part of it is all of what you've just said, but another part of it is because the equity that people have in homes right now is so strong because of this trend line of values and so on, based on, supply and demand and real things, not kind of magical investment vehicles that we had back in that time. Even if somebody really lost their job and was really in a hard place, they could sell their home in like a heartbeat, right? And they have equity in that, pay their note. There's not going to be a foreclosure there. There's going to be somebody that has to move from a homeowner to a renter, which sucks for them. And they may have trouble, making their bills because they lost their job, but that's their problem. That's not a housing problem. So don't get excited about picking up a bunch of cheap foreclosures anytime soon.
For sure. So, really what we're trying to do with this data is shift people's mindset and opinions from conjecture and it feels like to, okay, I get it. There's no doubt this market is manic. Agreed. I'm with you 100%. But the why is very different. And that's really what we're trying to drill into to buyers here.
Hey, Ben, another thing that people are really focusing on too is the cyclical nature of real estate, right? How many times do you hear that? We're due for it to happen again. And so they're tying that together with the high prices, is that the bubble's gonna burst again. And it's because they're not looking at the factors that are causing the high prices like Josh was talking about. So just because you look in the past and say, well, it happens every 7 to 10 years, look back in history, we're due, doesn't necessarily align with the data.
That's exactly right. Yeah, that's well said. And just one other thing, Ben, I'd go back to this slide and I'd say, look, right now, I think actually this number might be down to 1.3 million. It changes, right? Every couple of weeks it gets updated. But there was according to the National Association of Realtors, there was 1.07 million homes for sale nationally. Well, there's 330 million Americans. So if you do the math, roughly, there's one home for sale for every 330 Americans. That is woefully undersupplied, and there's no way you're going to have a fire sale situation and foreclosures when you have super low inventory like that. And then, Ben, the other thing that I would mention to him is, look, let's go deeper into this why there was a recession and a crash after 2006. Because yes, it was manic and real estate was in vogue, but there were some factors that were at play in the background that really destroyed the real estate market. And if you understand those, you'll be able to contrast them from what we're seeing today. So these are births by generation. So these are by each generation, your baby boomers, Gen X, millennials, Gen Z. This is the number of people that were born in each of those generations. And according to the National Association of Realtors, the average age of the first-time home buyer is 33 years old. So if we look back 33 years and we look at the number of births that were happening at that time, we should be able to forecast, generally speaking, the demand for housing. So if you look at 33-year-olds in 2006, you were having this fall off from the baby boomers, which is a huge generational shift. And the number of births went from about 4.25 million down to 3.25 million. So that's a 25%, in some cases here, maybe as much as 30% reduction in first-time home buyers. Interestingly enough, 1973, which was 33 years before 2006, Roe versus Wade passed and abortion became legalized in America. So part of this demographic trough was just the normal fall off from baby boomers to Generation X. And then boom, we saw an additional demographic trough because of the impact of Roe versus Wade, which means 33 years older, there's 25% less first-time home buyers entering the market. That is very different from what's happening now. Now we have the millennials, which is the largest demographic wave since the boomers. And our demographics, if you see where we are today, we're approaching again 4 million 33-year-olds. 4 million Americans are turning 33 each year. And if you look from where we are here all the way into Gen Z, you'll see that demographic line trends around 4 million. So we got crushed in this trough, but that's nothing like what we have going for the next 20 years. Does that make sense? I went through that a little faster than normal, but did that land? Cool. The other thing that's different between 2005, 2006, 2007 today is the quality of our borrowers. You see, in 2004 to 2007, where, when they had liar loans, stated income, stated asset, stated credit, fog and mirror, you're good, anybody could get a loan. You had the local bartender, cocktail waitress, taxi driver that were, all of a sudden real estate investors and had 15 homes under contract. Today, so that kind of fueled that speculation and boom in construction. Today, it's a very different world. We've gone since 2008 with some of the toughest lending guidelines and underwriting criteria that we've ever seen. So these buyers that are, that you're competing with, they all have credit, they all have assets. Most of them have significant down payments, and they actually can qualify to pay for their loan. So that's another big difference. One last slide on this. This is just a measure of default risk according to the Urban Institute. And they're showing that the borrower's risk because of their qualifications is extremely low going back since the crash and the bottom in 2008, and that the product risk is very low. The other thing, this red area, if you remember, these are these neg-am loans. These are these arms loans that you pay less than the interest is accruing. So the balance of the mortgage is going up. There's no neg-am loans anymore. They're 30-year fixed, they're 15-year fixed. Maybe you'll see an arm out there, but they're all amortizing loan. So you have less mortgage product risk and less borrower risk because they're all actually qualified. And so as a result of that, all those things, the supply and demand imbalance, we're seeing massive appreciation. You'll see in Utah, on average, the average homeowner earned $39,000 last year, according to CoreLogic. And the appreciation rates, the most recent appreciation rates would even have this higher. There's some data that just came out today that we talked about. So that would be like the education. And we might pare that down a little bit depending on the borrower. If they're really skeptical, then we'd probably go into all those slides. If it's someone that we felt just, needed a little help understanding the market, we may pare that down a little bit. But the first part of the Bulletproof Buyer program is for us as lenders, as a loan officer, to get our buyers to understand the why behind this crazy manic market and to tune out their crazy uncle that says, oh, the market's about to crash. It's cyclical. It's going down. Like, no, here's the facts of where the market is. The next thing that we want to educate clients on is that the appraisal process is a little kooky, and it's the hardest job in the real estate business, in my opinion. So let me just read through these real quickly. The most weighted indicator of value is what a willing buyer and willing seller agree the price is in an open market with ample marketing time. Unfortunately, so why then are appraisals coming in low? Because the speed that things are appreciating leaves no data to support the price. Appreciation is happening too fast to rely on historical data. So I'll give you an example. I just did a loan for one of our processors, and the comparables in that neighborhood, the appraiser used comparables for 6 months ago from December. And I'm like, we have to have a time adjustment because values are going up 1% or more per month. And so that becomes very difficult when appraisers have to use comparables in the last 6 months, but that homes are appreciating so fast. So the reality is there's a pretty good potential that the appraisal won't come in at current market value because when you're negotiating with a seller, you're negotiating on what today's market is, what buyers and sellers are willing to agree to sell the property at. When an appraiser looks at it, they're looking at historical data. So there's a pretty good chance that there will be a gap between the appraisal and the purchase price. Ben kind of did a presentation on this a couple of weeks back, so I'm not going to go into it in super detail, but just high level, this is how we would walk a client through the potential of how are we going to solve for that. So in this illustration, and again, it's easier to solve for this the bigger the down payment the client has. So if somebody has Utah Housing 0 down, appraisal gap strategies include gift from family. I mean, that's about it. If somebody has 20% down, 10% down, 15% down, we have a lot more options. But here's a couple illustrations. This is somebody, and this was a client that I was working with in California. So this was actually a conventional loan in this county, conventional loan size, $640,000. And they were doing 20% down, and we were assuming an $800,000 purchase price and an $800,000 appraisal. So this is what it looked like going into the transaction for this gentleman. Whoops, appraisal comes in at 725. And the key to the appraisal gap strategy, because there's a dozen pivots we can make to try to make this work for a buyer, but we have to understand what's the hot button for that buyer. Is it the monthly payment? Is it the cash to close? What is the thing that we have to solve for if the appraisal comes in low? In this case, this is a real live illustration. The appraisal came in 75 grand low, and the issue was The guy had 175,000 in cash. That was it. No more. Can't come up with any other money. So what we did was we moved from an 80% loan essentially to a 90% loan. And we had a upfront mortgage insurance premium. So this is a one-time premium that that has a fee that we pay the fee, and then the borrower does not have monthly mortgage insurance going forward. Well, how do we pay for that fee? Well, we paid for it in actually 3 different ways. First of all, believe it or not, in a conventional loans, there's what's called loan level pricing adjustments. And if you borrow greater than 80%, like if you do an 85 or 90 or 95% loan, you have mortgage insurance, and it actually gives you better pricing on the loan. The loan pricing is better at an 85, 90, or 95% loan to value than it is at an 80% loan to value. You have to get down to a 75% loan to value to get the same pricing as you would with a loan with mortgage insurance. Because for the lender, 80% has more risk than 90% with the client paying the mortgage insurance because the lender's insured. So in this strategy, we covered the upfront mortgage insurance from 3 sources. The cost of the mortgage insurance was roughly 1% of the loan amount. So it was about $6,400. We got a loan level pricing adjustment, which equaled a 0.5 point. So we covered half of the cost for the mortgage insurance there. I kicked in 25 basis points or 0.25%, and the realtor kicked in 0.25%. Problem solved. We all took a little bit of a concession. Buyer came in with less cash to close, and his payment went up $20, $16. But we solved for the issue that the guy had 175,000 cash to close, couldn't go up. Ben, anything you'd add there?
No, I think you covered it well. It is critical, as you pointed out, that the more they're starting out with as a down payment, the more room we have to play. I did just have one of these where they were bringing in an exceptional down payment, over 20%, actually 26 or 7%. So I could play around within the same pricing structure because we put less down to cover the gap, and it didn't even move them at all out of their pricing. So that was fortunate. Same cash to close, everything looks identical to them except on paper. But down to 10%, this still is an option. Below 10, it gets a little dicey, unfortunately. But if they're putting but the thing is right now, I mean, who's out there really trying for that 3% down first-time home buyer loan? You're getting crushed on that anyway. So I think most people we're dealing with now are putting at least 10% down. So this is a good option if it comes up.
Yeah. Jeff, were you going to add something there?
Exactly what Ben just said, kind of like he had mentioned in his previous training, that sweet spot is or the minimum sweet spot is kind of 10%. Less than that, it's hard to employ many creative strategies. So, I mean, just keep that in mind with your clients, guys, that if they have 10%, I mean, they might be competing with somebody that has more, and that appraisal gap could kill them, right? Yep. But now knowing that there's other options and you can talk to your lender about, well, what are our options to cover it if it does come in lower? This is something that most lenders don't talk about. And so, Josh, I want to just kind of bring up multiple states because I know Cassandra's in Florida. Gary, I'm not sure where you're at. Bruno, are you guys in Utah? I know Nate's in Oregon. And
Gary's in Utah.
Gary's in Utah. So Josh, and you licensed in Florida?
We are. Yeah, Ben, you're in Florida, right, buddy?
Yes, sir, I am.
Yep.
Okay, cool. Just want to make sure everybody on the call was kind of covered that way so that they could reach out to you.
Can't you tell by Ben's epic tan that he's in Florida?
It's reflected light only. It seems like I never leave this office, but hey, I gotta jump a little bit early, so I don't want to be rude and just like drop off. So I'm giving you a heads up. I'm going to drop off here in a second, though.
No worries, bud. Thanks a lot. Thanks for coming. Thanks for your contribution. Just one more. This was another real life situation. It was a client who, again, it was a jumbo loan. He was buying 1.5 million. We went into it thinking that this is what the loan was going to look like. and whoops, appraisal comes in at 1.35. By the way, the other thing I should mention is that the first thing that we do whenever appraisal comes in low is we reach out to the buyer's agent. We also ask if we can reach out to the listing agent, and we try to compile comparables. And we can send up to 5 comparables back to the appraiser and ask them if they'll reconsider value for something higher. But in most of these situations, I reach out to the buyer's agent and ask for comps, and they're like, yeah, there's no comps. you're good luck with that one. So, but that's the first line of defense. If that doesn't work, then we go here. So in this illustration, the appraisal came in at 1.35 million. We moved him to an 89.9% loan to value jumbo loan. His rate went up. There's no mortgage insurance on this product, no buyout of mortgage insurance. The rate went up. But at the end of the day, he came in with a roughly the same cash. His payment went up $200, $400, which isn't great. But at the end of the day, he was just stoked that we had an ability to get him in the house. And like I said, well, at the current rate of appreciation, you're going to have 20% equity in a year. So trust me, I'll have my reminder set at month 9. I'll be reaching out, looking at the value of your house. We'll refinance this thing. We'll waive all of our lender fees if you refinance with us in the first 2 years, and we'll get this down to market rate as soon as you have 20% equity. And he was like, at that point, really, I don't care. Just please get me and my family in this house. So that's it for the appraisal gap strategy. I'm going to move on to the third component of the Bulletproof buyer program, which we did a training on previously on Revive. So I'm going to retouch on that. So actually, the first part of this third component is to position the borrowers with a fully underwritten approval. So if they don't want to use the Revive program that I'm going to mention next, we should be getting them fully pre-underwritten. And as long as they're serious and they're going to make an offer in the next 60 days, the reality is every time we run somebody a pre-underwriting, if I look at the number of women and man hours it takes to actually do a full underwrite, it costs us just in labor and time about $750 to take somebody through this process. So we do not want to take people through this process that aren't like really committed that they want to buy a house. But once they commit to us that they want to work with us and move forward, I'm suggesting that they get fully underwritten. So you have an underwritten signed approval letter, and that when you go in, you're essentially the income, the credit, the assets are underwritten, approved. We just need the property, the title, and the appraisal. So requirements for us running somebody through a full underwrite is we want them actively making offers in the next 60 days. Like if someone's looking in December or maybe next year, we don't want to spend the $750 to pay an underwriter and everybody to process their loan. We want them to be ready to provide all documentation for full underwriting approval. So they gotta go all in. They have to understand the vision here that once you're underwritten and approved, we can close in the matter of a couple weeks. So we got to gather everything up front. And we ask them if we're the right lending team for them and their family. In other words, we don't want to run them through a full underwrite, then have them go get under contract to close a loan in a couple of weeks, and then have them say, oh, hold tight, I want to go shop 5 lenders, because that's just going to end up in a catastrophe for them, because now they've got earnest money hard, couple week close. It's not good for anybody at that point. So this is just a discussion that we would have with a client before we ran them through a full underwrite. And then the last part of this, this component of this Bulletproof buyer program is the ability to submit an all cash offer. So for those of you who were with the training that we did a couple weeks ago, Revive is a real estate finance company that turns your buyers into cash offers and focuses on maximizing profit for home sellers. So they have 3 different programs. They have a home concierge, which is for sellers who want to maximize profits. This is the renovation program. Basically, if you go into a house and you're like, whoa, cat piss, no handrails, broken windows, this place is a dump. Well, they have a financing program where they will finance and work with contractors to renovate and optimize that house so that the seller can maximize their profits. I don't know, in this market, maybe cat piss and broken handrails don't matter. You're probably selling 2 days anyways. The trade up is the one that I think is really, really interesting, where somebody has a property for sale that they want to sell. They want to trade up to another home, but they're worried to buy the new home. They're worried to sell their current home because they don't think they can get under contract on a new home. So the trade out program, essentially Revive will use cash, buy their new home for them in cash, and then allow them up to 6 months to sell their current home. If they need to do renovations or whatever, they can do that. They can move into the new home right away. They're going to pay rent on the new home. And then when they sell their home, then they actually buy the end home that Revive bought originally. There's a 3% fee for that for anybody who wasn't on the previous training. So if they, if a buyer bought a home for, if Revive bought a home for 500,000, they would sell that home to the buyer for 515,000. But if that's what it takes to get a house, a cash offer, and that's what it takes to get them out of their other home, it very well may be worth it to get the deal done. And then the Sell 360 program is basically like cash for clunkers. I'll buy your ugly home. They'll just come in and within a couple of days, they'll just buy the house in cash regardless of condition. This is probably more usable in a slower market. In this speedy market, I don't know that that's the biggest bang for the buck. I think the trade up to kind of unfreeze the real estate market is the best. Jeff, any other comments on that at all or anything you'd add?
No, you explained that well. I will just kind of like reiterate what I said earlier. Josh is kind of combining 3 different trainings into one here to create this Bulletproof program. So either in the chat or send me an email, put your email in the chat or send me an email. We've got the state of the market, which he started with, which he spent an entire hour on. Ben did an incredible training on that appraisal gap coverage. And now we're talking about Revive. So these are 3 separate full trainings that have consolidated together for this killer program that Josh is calling the Bulletproof Buyer Program. So if you want those previous more extended trainings, reach out. But I agree, the trade up is a great option because there is inventory that could be in the market right now if the sellers had a solution to their fear and the uncertainty of, well, what am I going to do if I sell my house and I can't find one to buy? They flip-flop that and can actually go buy first. You're going to be able to help them sell. So that's not the problem. That's not the issue. And being able to have a solution for being able to lock something up is beautiful. And so I think reach out to Ben, reach out to Josh, and get that ball rolling with the client if that's if you have somebody in that situation.
Yeah, and the other thing is, I think where people can actually make the money back is, let's say the home that they're going to sell has a lot of equity, but isn't in the greatest condition. And that if the kids' stuff was out of there and you had some fresh paint and some carpet and it had more curb appeal, you could fetch a much higher price. So in my mind, the perfect illustration is buyers afraid to sell because they have no cash, can't qualify for the new home, and is afraid they're going to be homeless. So Revive comes in, buys the new home in cash. They move in right away and start renting that home. Meanwhile, they either do it themselves or use Revive's concierge service to modernize and give more curb appeal to the departing residents. And then they fetch a higher fee or higher equity net from the sale of their existing home, which kind of offsets the cost of acquiring the home via Revive.
Absolutely. It's a great combination to marry those 2 together. I will point out, because I was on that training with Revive, they're out of California. They're not in every state yet for the concierge program. So if you have a seller in that situation, they're willing to work with you to set up the contractors in your market, but it's going to take a little bit of time. So the more leeway they have, if you want to use that kind of like remodel fix-up concierge program, get that ball rolling sooner rather than later. And now they've got some established vendors in the market that could benefit other people as well. So am I right on that, Josh? They've got a handful of states already in, but they're willing to go pretty much everywhere if they have enough lead time.
Yeah, exactly. So there's two things that they have to do, and they have two different programs. So one, they have to get all of their forms for the acquisition, lease, and then lease option contract. They have to make sure they have those forms in that state. So that's step number one. They've already done that in Utah because they've done that trade up program in Utah. But if it was in Florida, like I don't know if they have those forms in Florida. So that he said that could take a week or two. And then the other thing is the renovation program, the concierge program, they actually have to go out and contract with those general contractors. So that would take more time. You would need to have a, hey, I'm going to buy the new house. I'm going to move out of the old house. And I've got 30 to 45 days before a contractor could start on that kind of renovation. So there's different runways for their different products. All right, so just to wrap this up, like what are the problems we're solving with this? And again, what we're suggesting is we will run your buyers through a bridged version of this training, depending on the client's bandwidth and what they can handle and how much data they want, and help arm them with all of these tools so that when they go out in the market, we can solve for these issues. And these are the issues that we want to solve for. We want you to be able to confidently on the clients offer up to their max purchase price and compete with cash offers because you've been fully approved. So no guesswork, we can close super fast. And when you make an offer to a listing agent, you can hand them an underwriting approval signed by an underwriter. You can remove your loan contingency with confidence because you've been through underwriting. You have an informed strategy around a low appraisal and can remove the appraisal contingency up front. Now, I would say that's true in when the clients have larger down payments. If somebody has a 3% cash for down payment, that is not the case. So we need to think through that differently with each client. But ultimately, that's a challenge we want to be able to solve for. And of course, we'll call or send a video to the listing agent upon the presentation of the offer and let them know you've been fully underwritten and explain the cash offer if that's the direction that you're going. So just for compliance reasons, so I don't, lose my mortgage license, there it is. There's all the disclosures. Thanks for putting up with that. All right, Jeff. So what are your thoughts on rolling this out to clients? How can we, we're really beta testing this idea that we're culminating together to start teaching clients. But what are your thoughts and feedback or any questions?
Anybody else have any questions? Josh and I could have commentary and finish up the hour, but I want you guys to participate.
I have a question. Josh, are you in Washington State? I may have asked this question before in one of your classes. I've been to a couple of them.
Yeah, I'm not personally in Washington State, but our team is. I'll look right now and see if Ben or Mike, who have attended previous trainings, are in either of those states.
Okay. Thank you.
Yeah,
so
my
it's
pleasure.
pretty
Thanks,
much the northeastern part of the United States that you're not in, if I remember, Josh, right?
You're exactly right. Yep.
Okay.
Yep. Yeah. I mean, so Mike Jones, who's been at previous NEO trainings, he's licensed in Washington State. And if you want a local lender, that actually has an office in Washington, I'm more than happy to connect you with somebody who's executing on this same bulletproof buyer strategy that has an office there in Washington. I'll put my email in the chat, Kathy. If you want me to make that introduction, shoot me an email.
So Gary, you say you're in Utah, Florida, and Washington, and then it says, and what was that next comment? Oh, 10 others. Gotcha. You so wow, you're spread out there. That's awesome. So again, the northeastern states are pretty much the ones where the NEO home loan team is not as of right now. So if you're over here in the West or Midwest, you're probably covered.
Yeah, very well said.
Hey, Josh, it's Cassandra from Florida. How are you?
Hi, Cassandra. Doing great. Thanks.
I have a very strange appraisal question to
Shoot.
ask. When you guys send out an appraiser and the appraisal report comes back, do do you guys over there in your state, do you guys account for land value? Is that something that is adjusted? Let's say that your subject is, I don't know, let's say it's 3/4 of an acre, 0.75, and then all the other comps are 0.25. Is that an adjustment that an appraiser should do, or is that something that can be zero value? Strange question, I know. I have to ask.
It's a great question. So and commercial appraisals, construction appraisals, and residential appraisals are all done a little differently. But residential appraisals on 1 to 4 family units on existing housing, which I assume that's what you're talking about.
Mhm.
Those appraisals are comparative market analysis. So what comparative market analysis is that they will find the most similar comparables. They usually, will find 3 to 5 similar comparables, similar age, similar size, close proximity, similar age,
Right.
similar condition. And then they should have adjustments. So
Right.
let's say you have a $250,000 house and the house across the street sold for $230,000, but yours has a bigger yard. You have a finished, an extra finished mother-in-law above the garage. There should be adjustments to offset for that difference. But here's where people get, frustrated, is they'll say, hey, I have 3/4 of an acre.
Yep.
The comp that you're comping me against, or comps only have 1/4 of an acre.
Right.
And so, a 1/2 acre lot in my subdivision would sell for $100,000. So my house is worth $100,000 more. It doesn't work that way. What the appraiser has to do is they have to go out and look for comparables that have larger acreage, and then essentially use deductive reasoning to back out how, if someone's buying a single family home and it's on larger acreage, how much more are they willing to pay? And so they assign a value. They should sign in a value adjustment for that, but it's not the argument I've heard from, some people, which is, well, wait, mine's a 1/2 acre bigger, 1/2 acres sell for $100,000. My house should be worth $100,000 more. It doesn't quite work that way.
Right. And the reason why actually me. I bought a house. I just bought a house that's 3/4 of an acre. Okay. It's the largest house in the community. And this appraiser went out there, but actually he didn't go out there. It was a desktop appraisal. It wasn't. So he comes back with the report and he makes adjustments, and the comparables are okay, whatever it is, what it is. But he put zero value on the 6 comparables, because the other comparables were they were 14,000 square feet, almost 15,000 square feet. As far as I'm talking about land value. And my house, my land is 31,000 square feet of land. And the others were 14. So I had to dispute it. But the appraiser says, land doesn't matter. I was like, wow.
Yeah, I'd ask for a full appraisal. That's what that would be my ask. I'd say, hey, I want you to convert this to a full appraisal. There is something called an over improvement or super adequacy. So because it's a comparative market analysis, like if I build the Taj Mahal, that is $1 billion building in West Valley City, Utah, which is where I grew up, by the way, it's not going to appraise for $1 billion. Because it's a comparative market analysis, and there's nothing to compare it to that would substantiate that valuation. So if you have a over improvement or super adequacy, that means you're so far beyond what the other comparables are that they can't really prove in a comparative market analysis what the value of that over improvement is. I don't think that's the case in your situation, but that might be what the appraiser's kind of, banking on. I'd ask for a full appraisal and a second opinion for sure.
Oh, okay, great. And my last question is, how do you guys factor in whether it should be desktop or full? Like, how does a bank know which one to do?
Are you getting a home equity line, or are you getting a full first mortgage?
It's a full first mortgage.
Okay. So it would depend on the automated underwriting findings. So when somebody runs
Oh,
automated
okay.
underwriting through Fannie or Freddie, it's going to tell them whether you need no appraisal, a full appraisal, or a drive-by appraisal. But you should be able to request a full appraisal, especially if you're willing to, pay for the difference.
Oh, okay. I didn't know that. Yeah, we're putting 20% down. So that's why I was wondering why did it not go out there? I thought it was maybe COVID related, but all right, that makes sense. Well, thank you so much. I appreciate it, Josh.
My pleasure. Good luck. Let me know if I can do anything to help.
Thanks.
Hey, Josh, I got a quick question.
Yeah.
So
How's it going, bud?
good. Thanks for jumping on.
Yeah, my pleasure.
So on the appraisal gap situation, it's amazing that we can kind of fix that issue when it comes through. If we are working with, you, Mike, or Ben, or your team right from the beginning, is it pretty simple to reverse engineer and know exactly what a buyer can do? Say if they've got 10 or 15% down on $500,000, we can say, you can go over this amount of appraised price in this range and be able to keep your monthly payments pretty close. So we kind of know going in, when they see a property that we know is going to be competitive and a property that they love, we know if we have the option to be as aggressive as we want or back it off a little bit.
Yeah, the great question. So this is an analysis that we used to do for clients reactively when the appraisal came in low, but now we're starting to present it to clients proactively. So, this is a $1.5 million house, but it doesn't matter. What we used to do is the same things for a $150,000 house. Good luck finding that. But we used to say, okay, here's what we had initially intended when we structured your loan, and here's what we have today. So it's easy for clients to compare, what the difference is now that appraisal came in low. Well, now what we're doing is we're starting to create these appraisal gap conversations prior to them writing an offer, saying, assuming that your value is going to come in, here's what it looks like. If it doesn't come in, here's how we're going to pivot if you don't want to bring in more money. So we're just kind of shifting from a reactive strategy to a proactive strategy. But what I would encourage you to do is, if you're working with a certain client in a certain price range and it's crazy competitive, I would give guidance to, Ben or Mike and say, hey, I'm pretty sure we're going to go 10% over. So can you explain, the why and the appraisal gap strategy up front, so we're not, trying to figure that out in the middle of our 14-day close?
Right, and this is a good conversation to have right up front, because almost all offers are including some sort of appraisal gap.
Yep.
And if the buyer says, well, all I have is my down payment, they only know what they know, right? So it's our job to introduce them to somebody like Josh that can give them a scenario that may or may not come into play. It might appraise, but if it doesn't, what's plan B? And if you're happy with plan B, sometimes you need to act as if that's going to happen and offer that amount over appraisal so that you can, be a dog in the race, right? Otherwise, you might not even be considered because somebody else is willing to cover this potential elusive appraisal gap that may or may not come into play. So I think it's huge to show them like that, Josh. Well, this is what your payment would be. This is what your new payment would be. This is your out of pocket. I love also including in that strategy, hey, this is what we can do. I know you didn't like this payment that's $400 a month higher. This is $1.5 million home, right? But we could refinance you later and get that back down. But we got to get you in the home you want. So I guarantee you not many other realtors are having that conversation with their clients.
Yeah. And basically my conversation with that client was you're going to pay an extra $400 a month based on the current appreciation trajectory. You're probably going to make that payment at that higher payment for somewhere between, 12 and 24 months. So would you pay an extra $5,000 or $10,000 for this house? He was like, hell yeah. And he's like, it'll appreciate that much in a month. And I'm like, great. Well, then we should go with the higher interest rate and we'll refinance you once you have the equity.
That particular house would appreciate that much before closing.
Yeah, it probably would. Exactly. Exactly. Yeah. The other thing, Eric, just to go back to that, because this is such a hot topic, like in this scenario, the conventional loan where we switched to LPMI and we picked up 0.5% from the loan level pricing adjustment, we threw in a lender credit for 0.25%, like there's like $2,200. And then the realtor threw in a $2,200 credit. Like the impact to the client was zero. Well, I guess not zero. What is that? $16? But I mean, close to zero. I mean, he actually came in with less cash to close in this illustration, and his payment went up by $16. So, just knowing when you're going to go into, hey, I'm willing to pay 10% over appraisal, for us to run a side-by-side like that and say, yeah, your payment's going to go up $16. Do you feel comfortable with it now? Heck yeah, I feel comfortable with it. It's such a negligible shift to them. So again, if they have the 10% or more down, there's shifts we can make that should make it palatable to clients.
Thanks, Josh. Can't overexpress how important and great that information is in this market right now.
Yeah, my pleasure, man. And I'm really excited we've got a couple of our loan officers that have deals going with Revive. And so I'm really excited to see how that plays out, because I see I feel like the biggest challenge we have in terms of inventory is that it's frozen because people are afraid to sell their homes and be homeless. So I'm really excited to continue to play with that. Please, anybody let me know if I can, help in that situation or have a conversation with a client that it might help.
Awesome. Appreciate you, Josh. Good information as always. One last reminder, if you want those previous trainings, reach out to me and I'll make sure you get those. The reason Josh just mentioned that he's got a couple of clients that are working with Revive is this is a new relationship. Kind of came about from a conversation we were having on how do we give our clients a competitive edge. And we were talking about a lot of these things that Josh just mentioned, and Revive already does that. So rather than us having to implement them and pool together resources to create it, it was a good find, a good relationship. And they introduced their programs to us for about an hour. So I'm excited to, have an opportunity to try them out as well.
Yeah. And Jeff, I got all their forms too. At least they sent me all of their California standard forms. I've asked them for their Utah forms. I'll send those over to you, but it's pretty straightforward. It's just it's a purchase contract where they buy in cash. It's then a occupancy and rent agreement. And then it's a lease option contract between the buyer and Revive to buy it. So it's all super straightforward and very easy to explain to clients from what I've seen.
And I think their website is iloverevive.com. Is that right?
It is.
Want to check that out? iloverevive.com. Cool.
Yep.
Awesome. Well, thanks again, Josh. I love the new schedule for you particularly. Josh is a 3 a.m. riser, in case you didn't know. That's why we're teasing him. He's got to go to bed.
It is getting close. I got 26 minutes.
Yeah. No, we love you. We appreciate you. Guys, any final comments or questions before we let you go?
Thanks, everybody. Great to see you tonight. Sure appreciate you. Email me anything. I'm always happy to help or give you my advice.
Thanks for the unfair advantage. We love it.
You're welcome. Let's get Bulletproof.
Let's do it. Let's do it. See you guys.
See you, everybody.
Thank you, Josh. Thank you, Jeff.
Hey, Cassandra, I got a referral for you. I'm going to email you.
All right, wonderful. Thank you for keep inviting me to these things. This is fantastic information. And email me everything you have, because this is really good information for my buyers for sure.
Good. Well, glad you could make it. All right, we'll be in touch, guys. Have a good night.
All right, take care.
Bye.
Yeah.